So welcome to today's presentation. My name is Peter Yosef, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. Please allow me to add practically a label here. Let's start adding toolbars on the chart, slowly but steadily. Okay, so we've got everything practically here. Let's start adding labels, starting with the trading instrument, which is the US dollar index. Coloring this in black. There you go. Pretty visible. Now let's have a look at support and resistance lines. Definitely the US employment report for July on Friday was quite disappointing. However, we have to mention that on a second look, a cooler look at the rates and figures which were released, there was a more mixed picture of the US employment market. We definitely note that the NFP figure dropped below market expectations, which was the disappointing element, and tended to imply more or less that the ability of the US employment market to actually create new jobs has been reduced. On the other hand, we have to highlight here that the unemployment rate ticked down, which was not expected, while also I would be noting that the average earnings growth rate for July actually did not accelerate, it failed to slow down, which, with the unemployment rate ticking down, implying that the US employment market remains tight, and at the same time, average earnings continue to remain at the same levels, implying that they are about to continue to feed inflationary pressures within the US economy. That was more, if you prefer, on the bullish side for the US dollar. Nevertheless, though, the main element was the wider than expected drop of the NFP figure, which tended to weaken the US dollar. It's characteristic that the pair dropped, breaking the 102.20. On the other hand, though, we have to note that there is still an upward trend line guiding the pair. Sorry, the index. Definitely, though, for the time being, we're going to be turning the first support line into resistance line. And let's go hunting for a new ultimate resistance level. And I would be highlighting support level. And I would be highlighting this one. It's a beautiful downward throw. You can see how there was a steep downward motion, which was reversed after providing support and then to the upside. So we're talking about the 99.25 support level. Let's widen the chart a little bit. Let's add also some labels. Starting with the R3 at 104.55. Let's color this in red. Let's verify it. Yep. Moving now to the second resistance line, which is being placed at 103.15. First resistance line used to be support line. It's now being placed at tension 2.20. First support line being placed at tension 1.20, 100 ticks lower. Dark green. Second support line 100.30. And final support line S3 at 99.20. That's it. So let's talk direction. Now we have to highlight here that the pair seems to maintain its upward motion. On the other hand, though, given the upward trend line, on the other hand, though, we have to note here that if that was the upward trend line, that would have been broken. And that would force us to switch a bullish outlook in favor of a sideways movement initially. Mind you, the RSI indicator has risen back up, is just breaking the reading of 50. It's currently at 52.9. So there is a relative indecisiveness on behalf of the market, yet the bullish sentiment seems to be rebuilding. And that tends to imply some bullish tendencies for the pairs, for the index's price action, which could drive it higher, breaking the 102.20 and start aiming for the 103.15. It's going to be an interesting American opening, in my opinion. Here we go. On a more fundamental level, there were some mixed signals also from Fed policymakers. On the one hand, we had practically Atlanta Fed President Bostic, which more or less seemed to be content with the employment data. He mentioned that the employment market in the US is balancing out, and that tended to imply that, okay, we may be talking about the bank remaining on hold in order to recalibrate and see what the overall effect has been of the cumulative monetary policy tightening over the past months. On the other hand, though, we had also Fed Board Governor Michelle Bowman, and she stated that she thinks that more rate hikes would be necessary for inflation to come even lower. So the market now is turning its attention towards the release of the US CPI rates there for July and that due out on Thursday. Should there be an acceleration as expected, we may see the market's expectations for the Fed, to remain on hold being overturned for September. That may be sending a bullish signal out, a hawkish signal out, sorry. Now back to the technicals. So you have been asking now about the possibility of a bearish outlook. For the time being, that's improbable, but it's still a possibility and it should be covered. Should we see the bears taking over, the first element I would be watching out for would be the upward trend line. Should it be broken, that would be signifying the interruption, the full interruption, if not the termination temporary of the bullish movement. However, for bearish outlook, I would require the price action, okay, as we have mentioned, A, to break the upward trend line. But I would also require the pair to drop below the S1 101.20, which provides support back here, but also resistance once, twice here, and start aiming for the 100.30. Nothing less. That would also allow us to start drawing a downward trend line, showing us the limitations of the downward movement. Okay, let's have a look at Euro USD. Let's clear this chart. Now, once again, interesting to note, here you are. This has to be, it's no matter relevant. No, it's this one. I think we have a downward motion. On the other hand, though, there seems to be some support here at the 1.0945 support line. It used to be a resistance line, now has been turned into support level. Let's go hunting for a new ultimate resistance level. Moving out. Here you go. Could go even a bit higher, in my opinion. I would go all the way up. These peaks here cannot be neglected. Okay, there could be mid-level here, but I think this is clear. $1.1465 could be 70. Let's have a look. Yep. Locking it in. Adjusting the chart. Okay, let's place some labels here. Starting with the R3. 1.1470 in red. Place second support line at 1.1275. Sorry, resistance line at 1.1275. First resistance line at 1.1140. First support line at 1.0945. Second support line at 1.0835. First support line at 1.0675. So we have to discuss here practically the direction, and we are at crossroads for Euro USD. That should be clear. On the one hand, we have a downward trend line pointing clearly to downwards and seems to be respected. On the other hand, though, I have to note here that there are some stabilization efforts on behalf of the pair. It's characteristic how the differentials between the shows are shrinking, and the RSI indicator has reached the reading of 50, just below 50. It's actually at 49 and seems to be stabilizing. So that tends to imply more or less some sort of stabilization for the pair. Once again, should the downward trend line maintain, or if you prefer, remain intact, that could be driving Euro USD lower, breaking the 1.0945 and start aiming for the 1.0835, the S2. It's a level which, provided it was aimed for here, tested, retested, it held its ground. It's pretty valid. On the other hand, should the pair be unable to clearly break the S1 1.0945, then I would expect it to remain sideways, with most probably breaking the downward trend line, which seems to be guiding it. For a bullish outlook, however remote that scenario may be, it's still a possibility. But the prerequisites for a bullish outlook would be substantial. It would be required for the pair to actually break the pre-mentioned downward trend line, as we have mentioned, signaling the end of the downward movement. But at that point, I would also require the pair to rise and break the R1 1.1140, a level which provides resistance here. We may then see the pair start aiming for the R2 1.1275. Okay, let's have a look now at GBP USD. Once again, let's clear the chart. That's better. Let's restart setting labels. However, at this point, I would like to recalibrate also the resistance lines. Say, for example, there's a clear-cut resistance level here. Well, I would also like to note this level. See how we have a double peak here? It's very characteristic. So this would be the 1.3135. Let's place a label as well. Also, let's have a look at the S2, R2, sorry, which is being now at 1.2995. Let's place a label. Moving now to the R1. 1.2775. The first support line, which is being placed at 1.2590. In green. Second support line at 1.2490. And final support line at 1.2310. First discussion here is about the direction of the pair cable. And okay, definitely this is a peak. You can see how it has a downward trajectory, but there are also some signs of stabilization. I would like though to recalibrate this one somewhere here, because this is a low point which marks practically also the lowest peak right now, and that would be the 1.2620. So practically for the downward trend line, or if you prefer, let me rephrase that. Practically for the bearish outlook to be maintained, we would require the pair to drop, break the 1.2620. Why? Because we would require a lower truth on this one. And in that case, we may see practically the bears maintaining control. On the other hand, there seem to be some stabilization efforts here. Despite the RSI indicator remaining just below the reading of 50, it's currently at 45. And in that case, we may see the pair breaking the downward trend line we have mentioned, yet remaining below the 1.2775. And at this point, it would be interesting to recalibrate also the R1. Allow me to show this how, as the peaks here are double, one, twice. It's very slight recalibration to 1.2790. So practically, I would expect that should the pair stabilize, then we may see the downward trend line being broken, yet at the same time, the price action of the pair respecting the 1.2790 and remaining below it. For a bullish outlook, we would require the pair to rise, break the downward trend line mentioned, break the R1, 1.2790 clearly, and start aiming for the R2, 1.2995. Okay, let's have a look now at USDJPY. Let's clear the chart. Let's also clear past resistance support lines. Here we go. Let's label everything. Something before we start labeling. Let's draw a nice downward trend line if that applies or not. And in my opinion, it seems to have been broken. It's very, very interesting. Okay. So practically, if we're talking about direction here, there were some bearish tendencies over the past 48 hours, but during today's European session, the pair was able to rise, break the downward trend line guiding it. That forces us to shift any bearish outlook in favor of a sideways movement bias. I would be noting here also the RSI indicator, which has risen and has reached the reading of 50. It's actually right now at 49.4, implying that any bearish tendencies seem to have faded away. So once again, I'm switching the bearish outlook in favor of a bias for sideways movement to be maintained. At that point, we have to place also some labels here, would be far more helpful. Starting with the R3, 147.40. Second resistance line being placed at 145.10. Then we have the 143.55. Moving to the first support line, which is being placed at 142. Second support line being placed at 139.40. And final support line being placed at 137.25. Once again, for the first time, we tend to maintain a bias for the sideways motion to continue, possibly a little bit higher than the 142 support line. Should the bulls take over, we set as the next possible target for the bulls the 143.55, which was slightly broken here, yet provided good support here, resistance here, and support here and here. Now turn to resistance line. Next possible target for the bulls would be the 145.10, which provided resistance here. On the other hand, for a bearish outlook, we would require the pair to break the S242. That would be shifting practically the downward trend line to the right and start clearly aiming for the 139.40. Nothing less. We have to see a decisive move below the S2. Sorry, the S1. Correct that. Okay, let's have a look now at USD CHF. Once again, clearing the chart. Sideways motion seems to be maintained. That's clear. Readjusting it. Starting with the R3, which is being placed now at 0.8915. R2, which is being placed at, let's have a look at that again, 0.8850. R1, 0.8785. Let's verify that again. S1 at 0.8715. Let's color this in green. The S2 at 0.8655. And finally the S3 at, let's have a look, 0.8555. S3, 0.8555. So the sideways motion between the S1 and the R1 seems to be maintained, and we maintain our sideways movement bias, or the outlook if we prefer. The RSI indicator has risen, broken slightly the reading of 50. It's just above it. It's 55.5. Nothing convincing just yet for the bulls. On the contrary, I would be highlighting here that for the time being, it's still as if we're talking about a rather indecisive market. Yet, a small warning here, should the RSI indicator continue to rise and start aiming for the reading of 50, we may see bullish tendencies being developed for the pair. That should sum it up from all of us here at IronFX for today. Have a solid trading.
Hello and welcome to another IronFX video on an introduction to pips. This time we will focus on the units of everyday trading. And we will start with the smallest unit used, the pip. A pip is an acronym for percentage in point and is actually the smallest unit price movement an exchange rate can make. In other words, a pip refers to the unit we use to calculate the change in value of a currency pair. This is the relative value between two currencies. For example, if the value of the Euro USD pair moves in from 1.3723 to 1.3724, this means there is an increase of 0.0001 in the exchange rate. This is also referred to as 1 pip. Note that all major currency pairs are priced to the 4th decimal place with the exception of Japanese yen's currency pair that are measured to the 2nd decimal place. Gains and losses are easily calculated based on pips. We just multiply the position size by 0.0001. Let's look at another example. If there is a 10,000 unit mini lot position open and we want to measure the 1 pip movement, we just multiply 10,000 by 0.001. That is 1 pip, which equals $1 per pip. This means that for a position of 10,000 units each time the pair moves by 1 pip, there will be a $1 gain or loss depending on the way it moved. Put simply, if the Euro USD moves 100 pips in our direction, there will be a $100 profit. This calculation works for everyday trade size. Simply multiply the trade size by 0.001 or 0.01 for yen currency pairs. We hope you enjoyed this video. Stay tuned for the next one.
For today's webinar, we're going to be talking about backtesting your strategy on MT4 and MT5. So if you have any questions throughout the webinar, feel free to let me know in the chat and I will answer them as soon as I can. And we should be able to get through the slides pretty quickly. So we might have time at the end for some setups or looking at some live analysis. So feel free to let me know in the chat if there are any specific currencies or commodities that you'd like me to go through. And yeah, once I'm done with the slides, I'll be sure to go through those. Okay, so as per usual, before we get started, just a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, let's get started. So I'm Melanie. I'm from the company Everest Fortune Group, who are finalists for Best FX Research and Best Equity Research in the years 2019, 2020, and 2021. Okay, without further ado, here's our agenda for today. So we're just going to do a really brief introduction to MT4 and MT5 in case you are not familiar with them. And then we're going to do a comparison and then some tips for trading on MT4 and 5. And we're going to deep dive into backtesting. Okay, so MT4, short for MetaTrader 4, is a widely used trading platform that is highly recommended for beginner traders. So here we have a screenshot of just the the layout of MT4. So we have all of the charts laid out nicely, and you can minimize them as and when you wish. There are a few differences between this and MT5. I'll show you in a little bit. Let's get into some characteristics of MT4 first. So just a brief intro to MT4. Firstly, the access to multiple markets. MT4 provides access to various financial markets, including forex, currencies, stocks, commodities, and indices. This allows you to trade different instruments within a single platform. Number two, MT4 is really easy to install on your computer or mobile device. And most brokers offer MT4 as their primary trading platform and provide step-by-step instructions to set it up. Once installed, you can quickly create a trading account and begin trading. So MT4 also features an intuitive and user-friendly interface. The platform offers customizable charts, real-time codes, and a variety of technical indicators and drawing tools to help you analyze the markets effectively. Next, MT4 also provides a wide range of analytical tools. So these include built-in technical indicators, such as your moving averages, your MACD, RSI, so on and so forth, charting capabilities, and the ability to create custom indicators. So these tools can help you in identifying trends, patterns, and potential entry and exit points. So one of the key features of MT4 is the ability to use EAs. So EAs are automated trading systems that can execute trades on your behalf based on predefined trading strategies. So MT4 allows you to develop your own EAs or use the existing ones from the community. Next, backtesting. So MT4 also enables you to backtest and optimize your trading strategies using historical data. So you can test your strategies against past market conditions to evaluate their performance and make the necessary adjustments. Mobile trading. So both MT4 and MT5 offer mobile version for both iOS and Android. So you can monitor the markets and manage your trades on the go. And lastly, community and support. So MT4 has a large and active trading community. So on there, you can find online forums, tutorials, and educational resources dedicated to MT4. And you can learn from experienced traders and share your own knowledge as well. Additionally, most brokers offer customer support to assist you with any platform-related queries. Okay, next, let's take a look at MT5. So for MT5, here is the interface for MT5. You can see it's pretty similar, but there are just a couple of differences that we'll mention in a bit. So here are the characteristics of MT5. You can see there are a couple of similarities, but MT5 offers even more, or rather a wider diversity of financial markets. So this actually includes cryptocurrencies, which MT4 does not offer. So this allows you to diversify your trading portfolio and explore different market opportunities all within a single platform. Of course, they also offer stocks as well, forex currencies, commodities, futures as well. So next we have the user-friendly interface. We mentioned this earlier, so I'm just going to skim past it. And next we have the enhanced timeframes. So MT5 expands on the timeframes available in MT4. It offers 24 different timeframes for chart analysis. So this allows you to analyze price movements in greater detail and find trading opportunities that suit your preferred time horizon. Next, netting and hedging systems. So MT5 offers both these systems, providing flexibility in trade management. So if you're asking what exactly are these, so firstly, the netting system allows you to have only one open position per trading instrument. The hedging system enables you to open multiple positions, including opposite directions, for the same trading instrument. Okay, MT5 includes a depth of market feature, also known as level 2 data. So it provides you with information about the current bid and ask prices, as well as the available liquidity at different price levels. So this feature allows for better understanding of market depth and can assist in making more informed trading decisions. Economic calendar. So MT5 also incorporates an integrated economic calendar, providing you with important economic events, news releases, and their potential impact on the financial markets. So this feature helps you stay informed about key market moving events and adapt your trading strategies accordingly. Number 7. So MT5 offers advanced backtesting and optimization capabilities, allowing you to test and fine-tune your trading strategies using historical data. So similar to MT4, you can assess the performance of your strategies under various market conditions and optimize them to improve their effectiveness. So I mentioned earlier that both MT4 and MT5 are available as a mobile version as well. Okay, lastly, community and support. This is pretty self-explanatory, so I'm gonna skip that as well. So MT5 offers more advanced features. So it's important for beginners to educate themselves about trading concepts, risk management, and develop a trading plan. And it's more for a MT5 is more for a comprehensive trading experience since it has all of the features required all in one app. Okay. I've briefly touched on some of these, so I'm just gonna skim through these as well. So there are a couple of similarities that I mentioned earlier and a couple of key differences that we want to point out. So firstly is the programming language. So MT4 uses MQL4, which is MetaCode's language 4, whereas MT5 uses MQL5. Now, MQL5 is an enhanced and more versatile programming language compared to MQL4. So this offers more advanced features and capabilities for developing custom indicators, EAs, and scripts, if that is something that you are looking at. Next, we have market coverage. So we mentioned this earlier, but MT4 primarily focuses on Forex trading, whereas MT5 offers a wider range of instruments, including stocks, futures, options, and crypto. So MT5 provides traders with access to multiple financial markets within a single platform, whereas MT4 is a little bit more limited in its market coverage. Okay, next we have timeframes. So we mentioned this earlier as well, but MT4 only offers 9 standard timeframes, which could be enough for you depending on your trading strategy. But if you prefer looking at a wider number of timeframes, then you could look at MT5 since it expands this to 21 timeframes, providing more flexibility and granularity for traders. Hedging. So MT4 supports hedging, which means that traders can hold multiple positions of the same symbol in opposite directions. So it allows you to open both long and short positions simultaneously for the same currency. Whereas MT5, it eliminates hedging and adopts a netting system, where only one position per symbol is allowed, and each subsequent trade closes or modifies the existing position. Next, we have depth of market. So MT5 includes the DOM feature, also known as level 2 data. So it provides traders with information about the current bid and ask prices, as well as liquidity that's available at the different price levels. However, this feature is not available in MT4. As for our economic calendar, this feature is not present in MT4, but it is present in MT5 because it incorporates an integrated economic calendar. So it also tells you how prices will be affected based on the different news releases or economic events. However, even though MT4 doesn't include this, but there are many websites that you could use to strengthen your fundamental analysis as well. So one that we are really fond of using is the forexfactory.com, because you can adjust the weeks that you're looking at, weeks or days that you're looking at, and it'll tell you all of the important events. It will even indicate the significance of these events as well. So not too much of a problem if you don't have the economic calendar integrated into MT4. It's just more for ease and convenience. Okay, next is backtesting and optimization. So MT5 offers improved backtesting and optimization capabilities compared to MT4. So it allows traders to perform more accurate and detailed historical testing of trading strategies and optimize them based on various parameters. Lastly is the user interface. MT5 has a more modern and user-friendly interface compared to MT4. It provides enhanced charting tools, more customization options, and a more intuitive overall experience. So while it's important to note that these are the differences, but both platforms are widely used and supported by different brokers and offer a wide range of features and tools for traders. So the choice between MT4 and MT5, it really ultimately depends on your specific requirements or trading style, as well as the markets that you wish to trade in. Okay, this is just a summary of everything that I've mentioned earlier. Yeah, I've mentioned everything, I think. Let me just see if there's anything else. So MT5, because it uses a different programming, it's also slightly faster, 64 bits, and it's multi-threaded as well, compared to MT4. But if that's not an issue for you, then MT4 is good enough. Okay, yeah, let's move on. Tradable instruments. So these are the tradable instruments that are available on MT4 and MT5. Okay, but this list is not exactly completely accurate because it really depends on the broker that you are opening a trading account with. Okay, the only exception is that you can trade crypto on MT5 only. Okay, timeframes, we mentioned this earlier, but how exactly you can determine whether 9 timeframes or 21 timeframes, which is better for your trading strategy. 9 timeframes should be enough for swing and long-term traders, whereas 21 timeframes just gives traders an advantage for deeper analysis of your favorite assets. Okay, so technical indicators, MT4 offers 30 built-in technical indicators and 2,000 custom indicators from the free code base, whereas MT5 provides 38 built-in technical indicators to get insight into market direction. So in addition to the free indicators, MT4 also offers over 700 paid ones in the market. So it's definitely enough for market analysis. Okay, for charting tools, MT4 and MT5. MT4 has 31 graphical objects, such as lines, channels, the gun, and Fibonacci tools, shapes, and arrows to predict future price movements. MT5, on the other hand, offers us 44 graphical objects, including geometric shapes, channels, gun, Fibonacci, and Elliott tools. Okay, in terms of the types of orders as well, MT4 offers 4 types: buy stop, buy limit, sell stop, and sell limit. MT5 offers 6 types of pending orders. Those offered by MT4, as well as the buy stop limit and the sell stop limit. So we mentioned this earlier as well. So MT4 tends to be recommended for beginners because it's easier and simpler to use compared to MT5. So MT4 is the best platform to trade Forex because it was initially designed for the needs of Forex traders. However, the cons is that MT4 has fewer trading options than MT5 and is a little bit slower. So some pros and cons for MT5. It allows more markets for you to trade, has more charting tools as well, and more time frames. But it can appear to be more complex for beginners, and few robot and EA developers opt for MT5. So if you're wondering which is better, both platforms MT4 and MT5 are popular amongst traders. So in short, if you're new to trading, MT4 is the right choice. The basic functions in MT4 are more than enough for trading. If you already have experience, then you can try MT5 since it has more features. Okay, so top 6 tips for MT4 and MT5. Tip number 1 is to use the MetaTrader Market Scanner. So this is a powerful tool that can help you find trading opportunities because it allows you to scan for specific conditions, such as price movements, technical indicators, and economic events. So you can then use this information to make informed trading decisions. Number 2, create custom indicators. So custom indicators are a great way to tailor your trading experience to your specific needs. You can create indicators that track data points that are important to you, such as support and resistance levels or moving averages. So this can help you make better trading decisions and improve your overall performance. Number 3, use EAs. So EAs are automated trading platforms or programs that can help you to execute the trades. So we mentioned this earlier, but it basically helps you to place your orders, manage your positions, and close your trades automatically. So EAs can take a lot of guesswork out of trading and can be a valuable tool. Number 4, manage your risk. So risk management is a really important part of successful trading. You need to know how much risk you're willing to take on, and you need to set stop losses accordingly. So this will help you to protect your capital and avoid making costly mistakes. Okay, stay disciplined. So discipline is essential for any trader who wants to be successful. You need to have a plan and stick to it. Emotions can cloud your judgment, so it's important to remain calm and focused when trading. Tip number 6, have realistic expectations. So it's important to have realistic expectations because you're not going to make a fortune overnight and you need to be prepared for any losses. So if you keep your expectations in check and focus on long-term success, you'll be more likely to achieve your goals. Okay, so let's get into back testing. Okay, so what exactly is backtesting? So it's basically the use of historical data to test your strategy. Sorry about this, my throat is acting up because the weather is getting really cold. So backtesting is a crucial process in trading that involves assessing the performance of a trading strategy using historical market data. So it's just a way to evaluate how a particular trading strategy would have performed if it had been applied to past market conditions. So of course, it uses historical data, knows the behavior of your strategy, fix your strategy, and helps you to improve your strategy. So how exactly the process of backtesting is? Let's see if I have the slides here. Okay, these are some things to just watch out for. Net profit or loss, volatility measures, averages, exposure, ratios, and annualized return. But the process is typically you start off by formulating a trading strategy that includes specific entry and exit rules. So this strategy can be based on technical indicators, fundamental analysis, quantitative models, or combination of factors that we've mentioned on this slide. Next comes the data selection. So historical market data, such as price and volume data, is collected for the period over which the backtest will be conducted. So the data should cover a representative sample of market conditions, including different market cycles and volatility levels. Next, you then execute your trade. So the trading strategies rules are then applied to the historical data that we mentioned earlier, and then you simulate the execution of trades based on the strategy's signals. So this involves identifying potential trade, entry, and exit points according to the specified rules. Next is then comes in your measurement for the performance of your strategy. So the simulated trades are then tracked. Key performance metrics are calculated, such as profit or loss, win rate, average trade duration, and risk-adjusted returns. So these metrics help to assess the effectiveness and viability of the trading strategy. And then lastly would then be your analysis and optimization. So then traders analyze the results of the backtest to gain insights into the strategy's strengths, weaknesses, and areas for improvement. So they may adjust parameters, modify rules, or explore alternative strategies to enhance performance. Okay, that's just in case you were wondering how exactly you go about backtesting. So here's one of the strategies, tick-by-tick backtesting. So for tick-by-tick backtesting, you would require in-depth data, volume weighted into price, creation of elaborate models, prevent unexpected surprises, and you would need to simulate your trade execution, which is pretty similar to what I've recently mentioned. Okay, common backtesting mistakes. So firstly, you could get an unrealistic backtest result, and that's how you would know you would either have to repeat your testing, or change a variable which you would have to analyze. Next, do not overmine your data, because there are a lot of factors that come into play when you are trading, a lot of market conditions that are beyond your control. Next, getting the timing right. As I mentioned earlier, volatility is a big thing that could affect your results. So it's important to get the timing right for your execution of your trades. And lastly, incorrect assumptions. So based off of the results of your backtesting of your trading strategy, then you have a certain number of assumptions that you make off of those results, and not based off of whether you think that it's right or wrong. Okay, Okay, that brings us to the end of my slides, but let's go ahead and get started with some charts. So if you have any requests for any charts, feel free to let me know in the chat. One practical trick for backtesting. So most of the backtests are conducted on, excuse me, on any of the majors, typically, especially if you are trading Forex. So be something pretty basic like any of the majors. If you're trading commodities, then perhaps gold. Those are the common ones that are used for backtesting. If you're asking me to show you how to conduct a backtest, I can't do that now because that requires a software or programming language that's specifically designed for backtesting. So I can't exactly run the backtest for you guys to see currently, but if that's something that you are interested in, feel free to let us know and we could do a webinar on that soon. So maybe let's go ahead and analyze one of the majors together first. Okay, let's go ahead and analyze the euro dollar together. Okay, so as per usual, we want to look at the higher time frames first and then do a top-down approach. So we're going to take a look at our higher time frames first, just to get the general direction. So here we can see price moving upwards. That's our general direction on the weekly time frame. And if we take a look at our daily time frame, our general direction is upward as well. Let's see if we have a parallel channel. Okay, no. But we do all agree that prices look like they are heading upwards. I think we have a trend line here. Okay. Okay. Now we typically will do our analysis on either the 4 or 1 hour time frames. So let's go ahead and take a look at that. Okay. So first things first, we want to see if we can identify any trend lines or trend channels. Okay, it doesn't look like there are any trend lines here. Okay, but it does look like price is moving within this ascending trend channel. So for a valid trend channel, just to recap, you want to make sure that there are 2 touches on top and at least 2 touches below. Okay. So now that I've done that, let's go in with our support and resistance levels. So over here would be my first resistance. And you see, I want to pull it back as far as I can without cutting too many candlesticks, just so that I can see how significant this level is. So I've placed it here. I can see that price has tested this level many times in the past. Okay, and then this is my first support. So this is just purely based off of graphical analysis. So purely just swing highs and swing lows that are closest to where current price is. Then we'll go in later with our Fibonacci levels to adjust the levels accordingly if we need to. Okay, and then here is my second resistance. Okay, now that we've done that, let's go in with our Fibonacci levels. So I'm looking for a Fibonacci retracement. So for Fibonacci retracement, we want to look for, we look at 5 specific levels. We look at 23.6, 38.2, 50%, these 5 levels, 61.8 and 78.6. But I can see that my 38.2 lines up nicely with my second support. So I'm just going to go ahead and keep that. Okay, and then I'm going to see if I have another retracement over here. So same thing, I'm going to look at these 5 levels. And I can see 78.6 lines up with my second resistance. Now, even though the 61.8 lines up nicely with my first support, but because price has already broken this level, so we can no longer use it. Okay, whereas in this case, the 78.6 price has yet to retrace back to the second resistance at the 78.6 level. Okay, so now I'm going to look for a retracement. So for retracement, not retracement, sorry, projection. So for projection, we use these 3 levels, 61.8, 78.6, and 100%. And you want to remember when you're looking for a projection, that you want to look for this flash kind of shape, like a Harry Potter lightning bolt kind of shape. Okay, and in this case, I can see my 100% matches nicely with the second support and the 38.2. Okay, now that we have all of our Fibonacci levels, we can go ahead and include some indicators to support our analysis. So we typically like to use Ichimoku and MACD, and I can see price is moving above the Ichimoku cloud, giving us a bullish bias. MACD, however, is giving us a bearish signal. So I'm going to pull out RSI. Okay, and RSI is giving us this, or rather it's moving in this ascending trend line as well. Yeah. Okay, so I'm going to get rid of that MACD. So we can expect prices to bounce off of this level and head towards our first resistance. But since we can't find any Fibonacci levels to support this level, it's considered a pretty weak level. So we could see it break as well. But I do want to mention that even though we cannot find any Fibonacci levels, this level in itself has 1, 2, 3, 4 currently touches on its all on its own. So this is what we call a overlap support level. So it's a pretty strong level, and we could see price continue to bounce off of the level and continue within this ascending trend channel. Okay, and that's all for Euro USD. I think we have time for one more chart, so feel free to let me know if you have any requests. If not, maybe we'll just go ahead and do the XY, just a commodity instead of, since we've already done a Forex currency. Okay, so same thing, we're going to do a top-down approach. Can see on our DXY prices, this is kind of a downward movement. Okay, on our daily time frame, it's also looking like the general direction is downward, although there is a slight reversal here, but the general direction is still downwards as well. Okay, let's begin our analysis on the 4-hour time frame. Okay, I have this descending trend line, but I want to see if we have a descending trend channel. Okay, we do. So we typically will try and look for channels instead of lines, because trend lines, or rather for trend channels, it's a lot easier to see if there will be a continuation or if there will be a breakout of the trend channel. Okay. So now let's go ahead with our support and resistance levels. Okay, here's my first resistance. So for our first resistance, it's typically the closest swing high to where price currently is at. Conversely, for your support, it will be the closest swing low to where price is at. Okay, and then for the second resistance and support, that really depends on either the graphical analysis or on your Fibonacci levels. Okay, I'm gonna leave the second resistance out first. Here's my second support. Okay. So let's get started with our Fibonacci levels. So same thing, now I'm looking for a retracement. So earlier I mentioned that I will leave my second resistance for later. So this is the reason why. I'm just going to use my Fibonacci to help me. And the reason for that is because for this specific graph, we have a lot of swing highs and swing lows. Okay, here. Okay, so we have a 78.6% that lines up with my second resistance. And my second resistance is significant on its own as well because it is an overlap resistance. Okay, and I can tell my 50% Fibonacci retracement is nicely in line with my first resistance. Okay, now I think I have another retracement here. Okay, yes, my 38.2 lies nicely with my first resistance and the 50%. So this is a major confluence area for us to take note of. Okay. So now let's pull out some indicators once again. Ichimoku, MACD. So prices are moving below the Ichimoku cloud on our Ichimoku indicator, giving us a bearish signal. On our MACD, it's giving us a bullish signal. So same thing, I'm going to pull out RSI. Okay, RSI isn't really telling us much. So I'm going to pull up stochastic. Okay. So for our stochastic, you can see price has made a lower high on our price chart, whereas on our stochastic, price has made a higher high. So this actually suggests that there could be upward pressure pushing price upwards. Okay, but we would have to be careful because of this major confluence area with the 38.2 and the 50%. And this first resistance is also a double swing high. Okay. It's actually an overlap as well. So because of all of these factors, it's a confluence area. So we could see price reversing off of it, or we could see price pushing forward, that's suggested on our stochastic, pushing up to our second resistance, and maybe not up to our second resistance actually. Let me just because price is moving in this descending trend channel, we could see price break out of the first resistance, but still rebound off of the descending trend channel, because there is still a lot of downward pressure, since on our weekly and our daily timeframes, it gave us a general downward movement. Okay, so we have to be careful with this one. And yeah, I think that's all the time we have for today. But we still have a few minutes. So before I end, feel free to let me know in the chat if you have any other questions. Yeah, if not, you can feel free to leave the room. Thank you guys so much for joining today. Hope you guys have a great rest of your week, and I'll see you guys next week. Bye.